They both invest your money, they both promise growth, but only one is built for the everyday investor, and the other, it plays by a completely different set of rules. Hedge funds and mutual funds might sound similar, but under the surface, they couldn't be more different. One is safe, regulated, and designed for the masses. The other is aggressive, secretive, and reserved for the wealthy elite. So, which one is actually better? Let's break it down. For most people, investing starts with a simple idea: put your money somewhere safe, let it grow, and check back in a few decades. That's where mutual funds come in. The go-to option for millions of people saving for retirement, college, or just trying to keep up with inflation. But behind the scenes, in the upper floors of Manhattan skyscrapers, hedge funds are playing a very different game. They're not just trying to beat the market, they're trying to outsmart it, outmaneuver it, and sometimes even bet against it. Let's start with the basics. What exactly is a mutual fund? Imagine a giant pot of money, not just yours, but from thousands of investors. That money is managed by professionals who invest it in a mix of stocks, bonds, or other assets. You don't have to pick individual stocks or track the market every day. The fund manager does that for you. It's one of the most popular ways to invest, and for good reason. Mutual funds are heavily regulated, relatively low risk, and easy to get into. Most have low minimum investments, and you can buy them through your bank, brokerage account, or even your retirement plan. And when you invest, you're not buying a single stock, you're buying a slice of a whole portfolio. That means instant diversification, which helps reduce risk. Fees are usually modest, and you can sell your shares pretty easily if you need to cash out. In short, mutual funds are built for stability, simplicity, and the everyday investor. Now, hedge funds, that's a different beast entirely. If mutual funds are built for the masses, hedge funds are built for the elite. We're talking high minimum investments, sometimes in the millions, and access limited to wealthy individuals or big institutions. But what makes them so different isn't just the money, it's how they play the game. Hedge funds can do things mutual funds usually can't, like short-selling stocks, using high leverage, betting on currencies, commodities, interest rates, and even entire countries. They're designed to chase returns in any market, bull or bear. That's why they're called absolute return funds. They're not just trying to beat the market, they're trying to win no matter what. But that freedom comes at a cost. Hedge funds are barely regulated, they're opaque, and their fee structure? Typically 2 and 20. That means a 2% management fee and 20% of any profits. Win or lose, the managers get paid. You won't find hedge funds in your 401k or at your local bank. They operate in private networks with complex strategies, often outside public view. And while some make headlines for raking in billions, others blow up in spectacular fashion. All right, let's put them head to head, because while both are investment funds, they live in completely different worlds. Accessibility. Mutual funds are for everyone. You can start with a few $100s. Hedge funds, you'll need to be an accredited investor with serious capital, often in the millions. Regulation. Mutual funds are tightly regulated by the SEC. They're required to report holdings, performance, and follow strict guidelines. Hedge funds, not so much. They operate in the shadows, with far less oversight. Strategies. Mutual funds usually stick to a long-only strategy. Buy and hold. Hedge funds, they do it all: shorting, leveraging, derivatives, arbitrage, global macro bets. They're financial ninjas. Fees. Mutual funds might charge 0.5% to 1.5% in management fees. Hedge funds typically use the infamous 2 and 20 model, 2% for managing your money, plus 20% of any profits. Transparency. With mutual funds, you know what you're buying. With hedge funds, it's often a black box. You trust the manager, but you might not know exactly what's inside. Liquidity. Mutual fund shares can usually be bought or sold daily. Hedge funds may lock up your money for months, even years. In short, mutual funds are designed to be safe, simple, and accessible. Hedge funds are high-risk, high-reward machines built for those who can afford to play. So let's say you're holding some cash and wondering, which of these is right for me? If you're just getting started, planning for retirement, or looking for stability with a side of growth, mutual funds are your best friend. They're accessible, transparent, and diversified by design. They're perfect for long-term goals, like building wealth steadily over time without taking on crazy risk. But if you're an experienced investor, someone with deep pockets, high risk tolerance, and a taste for aggressive strategy, hedge funds might catch your eye. They offer access to complex investment opportunities, uncorrelated returns, and managers who are often betting big to outperform the market. At the end of the day, hedge funds and mutual funds aren't rivals, they're tools. And like any tool, the value depends on how and why you use it.